Welcome, everyone, to the forecast for 2015. I've been asked to be the keynote for RedChip, and that's an honor. So let's just start right off. I'm David Morgan. I'm the founder of themorganreport.com. You can find more about me on the internet at themorganreport.com. With that, RedChip Companies 2015. First thing I'd like to bring up to our attention is the cover of The Economist magazine, which shows 2015. And if you want to delve into this deeply, you can go to our blog at silver-investor.com, hit the blog button and read about it. But it's very interesting. They have the global leaders at the very front. Notice they're all in black and white. The entertainers are in color. There's a mushroom cloud over in the far right. The globe is in the upper right with one side looking a little disgruntled and one looking a little angry. There's lots of symbolism in this. I'm not going to go over it for you. What I want to point out is that the year 2015, our new year, certainly has a lot of tension. And in fact, the war drum, so to speak, is beating. And so let's go through that a little bit now. First of all, the Ukraine war. The Ukraine war isn't over. The tensions between the U.S. and Russia are more tense than they've been since the Cuban Missile Crisis. And Kiev has put their so-called anti-terrorist operations in eastern Ukraine mostly on hold for the winter. And yet the shelling has continued. So I'm not going to go through a whole thing. I just want to bring to everyone's attention some of these things at a top view. And then we're going to talk more in depth about not the problem so much as the solution. So the next one I think is the oil price squeeze. I suggest there you could certainly read a lot on the internet. The idea of having lower oil prices might be great if you're a mining company or you're filling up your vehicle at the gas station, or you have a transportation company or an airline, and all those would be factual statements. However, if you're looking at what it means for the global system, it is not beneficial. I did an interview with USA Watchdog, Greg Hunter. You can look that up on YouTube. And I give an overview of what these lower oil prices means to the financial markets, specifically in the derivatives. So that is something to very, very much pay attention to. The Syrian war. The conflict in Syria isn't going away. In fact, 2014 was the most deadly year on record with some 76,000 killed. U.S. airstrikes will continue in 2015, but they will not, in my view, destroy ISIS or even weaken it. ISIS has established its position with the help of U.S. arms and funding and sales at the point it seems to have produced. In other words, our own revenues has produced this problem. You can verify that on your own. You don't have to take my word for anything. The Syrian government will most likely continue to slowly weaken throughout the year. Next big one, Ebola. I have a question mark on it. We haven't heard much on the Ebola story for quite some time. It's dropped off the mainstream radar, but it hasn't gone away in the real world. The Sierra Leone has dramatically escalated a containment effort, but according to the Red Cross, the number of cases have in fact spiked in recent weeks, and the situation is far from being under control. So another area to pay attention to. One I don't even like to bring up, but I think I must because I want to be a truth teller and I want to get everyone's ability to spur some thinking on their side, and that's racial tensions. Unfortunately, heading into 2015, race relations in the United States are very, very tense. You cannot predict the kinds of events that will create a spark that may involve further escalation. We've already seen those. No one benefits from that type of scenario. As a side note, I just watched the film Selma last night, and I was very, very taken by that. Dr. King certainly was instrumental in getting us on track, but unfortunately, the system now is, unfortunately, the way we are right now, certainly looks like we have lost some of those lessons. So that is it for the negatives. So that's the overview, because I like to look at both sides of the coin. I don't like to be Pollyannish. I don't like to look at just the negatives. I like to look at both sides of the coin. So let's look at the positives now. So there's positives. There's opportunity always. Human beings have a great capacity to look at problems and solve them. We've done it for centuries. We'll continue to do so. So that means there's opportunity. One of them is the environment, and this goes across the board. You can look at the air quality, you can look at water, you can look at food. And something that's come to the fore more and more is recycling. In other words, being more cognizant of what we use every day and how we can reuse it. Containers, boxes, all kinds of things that we just are a little more conscious about, that this is a product, it took energy to make it. Can we use it again or again and again? And I think people are waking up. I mean, my generation, I was kind of at the end of the quote unquote hippie era. And in those days, there was a lot of thinking about conserving lots of things and, getting the best use out of things. And of course, that's kind of left our culture for some time, but it's coming back. So I won't belabor that point. Healthcare, huge with the Obamacare situation. The free market, what's left of it, and there is plenty left in some areas, there will be people that look at this as a big problem, and there will be solutions. And this is an area that I think demands some attention. Another one that I have a question mark on is money and new money. It's sort of my specialty, but there's Bitcoin and other types of new money coming into the fore that are outside of the government purview. And will it catch a foothold or not? I'd say Bitcoin certainly has caught a foothold. How far it goes and how much it brings in the public, it's hard to determine at this point in time. But the trend is clear. People are looking for alternatives to a central bank produced money. A lot of people, yours truly included, think that people question the ability of the banking system at this point with the quantitative easing and all that's going on in the larger picture. I won't go into that now. It's what I do at the Morgan Report. And if you want more information, you can come look at our website and read stuff for free or subscribe. So I like to say about the opportunities is that some people have the idea that they need to be an activist or have a YouTube channel or be a blogger or whatever. And none of that's true. Now, as investors, we are a powerful group, not only individually, but certainly as a whole. And the group of investors determine a lot of the outcomes. And what that means that if you're not part of the solution, are you part of the problem? I pose that question to you as an investor to think about. But what you can do is you can actually participate in these companies. RedChip features a great deal of them. Usually these are small companies that have big ideas and ways of attacking some of these problems that I outline in unique ways. I've been an investor for over 40 years, and I'll just caution you that some of these companies will make it and some won't. So you have to invest accordingly, which means no matter how good the story or who's at the helm or how much success they've had in the past or whatever, use some common sense. My approach, and this doesn't need to be yours, is I look at the ones I like the best, but I don't ever focus on one company. I diversify. I look across the board. I find at least 5, usually preferably 10. I put pretty much equal dollar amounts into all of them and then wait and see how they develop. But it's a great way to make large returns. My experience, and that's not necessarily your experience, has been I've had some huge winner in this sector. And I've had some that have absolutely gone to zero. Now, that's my experience. Doesn't mean that'll hold for you. What I'm trying to convey here is that there's just some real big opportunities, but focus that you need to invest accordingly. In other words, these are high risk, high reward situations. So don't focus on the best story. Focus on how to invest because you're an investor. And certainly putting your money where it belongs in these up-and-comers, I think is one of the best things you can do. So you're certainly participating in a very direct manner. I'm going to do a very quick briefing on silver investing because there are people that see my name out there and they'll tune in just to see what I say about silver. They think that's all I do, which of course is mainly my function, but certainly not the only one. So quickly, silver investment from a fund manager, money manager, institutional level has been flat for quite some time. As you can see from this chart, the ETFs went up at almost a 45-degree angle from about 2006 when the SLV started up for about 5 years. In the last 4 or so, it's been flat. So we haven't really seen any institutions come in a large manner in the silver market. So that's something to bear in mind. The other thing that I really need to stress is that how markets move. And all markets that have significant moves have 3 up phases and 2 counter trend phases. We've had 2 uptrends in the silver market, and we're near the end, I think, of the second downtrend, ready to go into the third leg up, in my view. I'm not a big Elliott wave guy. That's the basic theory of Elliott. Nonetheless, my experience and my studies, which I said has been over 4 decades, indicates this is the case. So with that in mind, I think we're going to go into a very large uptrend in both the precious metals. This chart that I'm showing, the future potential bubble coming up, something you can look at. These slides will be available for anybody viewing this presentation on Redchip. You can study it further, but what I'm saying is something I've said for a long time. What we experienced last time was 90% of the move came in the last 10% of the time. You could have held silver from 1965 through 1979 and got a gain from $1.29 to about $6. And that was, a decent gain over a 15-year time frame. But you could have been a speculator, bought it in 1979 in January at 6 and sold it in January 1980, 1 year later, near 50 for an 800% gain. So I'm not suggesting that's exactly how this market is going to unfold going forward. What I am suggesting is that these markets have big moves in the latter part of the cycle, and you should be prepared for that. That's a quick look at front page of the Morgan Report, which, by the way, you can go to this URL, www.themorganreport.com/free, and get a free look. We'll be publishing our new book, The Silver Manifesto, and that will be out at Amazon the end of January 2015. If you're so inclined, that's the front page of the website. And now I would like to take some questions from the audience.
Okay, we are just watching our keynote presentation with David Morgan of silverinvestor.com. And our Q&A is now open for anyone that has any questions. I guess to get things started, David, I mean, what are there any particular trends that you talked about in your keynote that you can expand upon a little bit?
Well, I think on the healthcare issue that there will be alternatives available that come out. Some of them may be on a preventative level. I think a lot of people, myself included, are pretty aware that, the healthcare thing is pretty much in your own hands. I mean, your health largely depends upon your eating habits, your exercise habits, your stress levels, and a lot of those factors are really under your own control. So I think there's a big opportunity, and of course we've already seen that out in the marketplace where there's being educated about health and, proper diet and all that type of thing is something that is an opportunity that we'll see more and more. So I think there'll be a lot of new situations, and they're already there. I mean, obviously I'm pretty tuned into what's going on, certainly could learn more every day, but, there's applications now that you can put on your phones that tell you, how many calories you burn walking around or, suggest a diet for you, whatever. So I think that's a growth area that plays into health. A lot of larger employers are willing to pay for a gym membership. Some of the larger ones have even put gyms into their facilities so that they get a deduction on their what they have to pay the insurance companies if they have an employee that actually works out 2 or 3 times a week at the company facility. So I think the trend is there. I think the overall trend has gone as interesting as I see it. This is my particular slant on it, that the big government thing has gotten bigger. I mean, even Clinton said the era of big government is over, yet we've just seen it grow and grow and grow. Nonetheless, I think there is a countervailing trend that will gain dynamics because people, understand that most of this stuff is our own responsibility. So that's one. On the recycling environmental case, I don't have any real further comment. And then as far as the overall theme that I ended with about being a smart investor, I'll just reiterate that I think it's important for people to take the big picture, get into several investments. Red Chip certainly has been the leader. I mean, tomorrow's blue chips. In a lot of cases, that is true. But again, invest wisely. In other words, what I like to do is add to a company if and only if it's starting to go the direction that they planned. In other words, for example, where I'm the most familiar in the mining sector, some of these exploration companies do become mines. In fact, not to brag, but a fact is a fact. I actually have taken more junior companies that have become mines than anybody else in the industry. That isn't by accident. It's because we do our homework, we do our due diligence, and we find ones that have the right people and the right asset pretty much to begin with. You can apply that same principle for the red chip type of companies, where as they develop and as they match their story or their mission statement, I don't mind paying more for a stock because they're still in a growth phase. In fact, that's actually the sweet spot to invest. So I think that bears some consideration by the audience.
Very good. Thank you for the further comments there, David. We've had several questions have come in, so we'll just jump into some of these right now. Can you comment a little bit about your feelings of the price of silver relative to the price of gold right now?
Certainly. Well, that's one I love to talk about, and the easiest way to do it is the gold-silver ratio. And obviously that means, how many ounces of silver does it take to buy an ounce of gold? And we've been as high as 80 to 1 at the beginning of the bull market, September 2003. We dropped as low as 35 to 1 during this bull market so far. And we're back up. We've been back up in the 70s. So the historic mean in the last 30 years is about 35 to 1. The overall mean, if you go back into the 12th century, are still down to below 20 to 1. So I believe that silver is very undervalued relative to gold. I think that it'll do a similar move that we saw in the late 70s, early 1980, where there's an acceleration in both of these markets, and silver out-accelerates gold. And I'm forecast to see what I call the monetary or classic ratio to be reestablished as about 15 to 1. I also know that markets overshoot. Not that that's the perfect price. I don't know. Market knows. But markets tend to overshoot. So if the enthusiasm for the precious metals gets extremely high, and I believe it will, then you could even see a ratio of 10 to 1. I don't think it'll establish that and maintain that. I think, again, that could be an overshoot situation. But from any metric you want to use, be it the cost of production, be it the amount in the ground, be it their place in technology, or the savings habits of the industrialized world, any metric you care to choose, silver is undervalued. So certainly I trade the ratio. I like to move back and forth. Sometimes these take years to develop where you would get the opportunity to move silver into gold or gold into silver. It's a like-kind trade, so it's a very good situation if you are invested in the metals to utilize that ability. And it is something that we do bring to the attention of our subscribers if they're curious about, working the gold-silver ratio to their advantage. When the time is appropriate, I don't get it right, but I've got it right enough to make gains for people. It's something that we do address.
Thank you, David. And while we're talking about precious metals, we have another question that's come in. Can you talk a little bit about the criteria that you use when you're evaluating a position in a junior miner?
That is extremely tough. I mean, I'd love to tell you about the top tier or the mid-tier, but the juniors are really, really hard. But I will. First and foremost, before I move to the next step, I try to evaluate the people. Dr. Bill Green taught geology at the University of Idaho years and years ago. He's long retired. But he and I became phone buddies decades ago. And then when I moved to Spokane in 1999, he suggested I come down and meet him in his office. And I actually forgot his physical location. And he reminded me. So I met him. But he told me something that I took to heart and have always remained, something that I adhere to. And that is, if you get the right people, they will keep working until they find something. And I really think for the most part that's true. So that's the first step. Now, the problem with the junior sector is oftentimes you'll find, one, you can't get any data on the people, or they may have had success in another area. They may have had success with a tech company, for example, or publishing or something like that. So if I can't vet the people, but the project still looks good, then the next thing is basically money. And that is, do they have enough capital to win, lose, or draw, sustain the company for 1 year, 2 years, 3 years? In other words, what is their drill, what is their burn rate on the company? So I look at the people, I look at the money. Then I look at the project. Where is the project? Is the project in a friendly environment? Is it very difficult to get to? And this is why we at the Morgan Report, in almost all of the junior selections, I couldn't say 100%, but almost all, we actually take a trip to the project. Because no matter how good it sounds on paper or on a map, or the CEO or the COO tells you, when you drive there, when you fly to the region, you get out and you get in the Jeep and you drive to the project, that tells you a great deal. Now, not to be cute, to be sincere, I've been on projects that actually had almost everything lined up almost perfectly for a good speculation, meaning the people were good, they had the money, the project was in a pretty safe area, and the infrastructure was decent. You could drive there, there's water nearby, there was townspeople nearby that worked in this facility if it ever became a mine, and on, except it was very, very near a place that grows a lot of drugs. And I'll tell you, that was a wake-up call for me, because I never even considered that path. But this is the power of being present and aware on a project. And I realized that had a situation that had all kinds of the drug cartel around that project. So I took a pass on that. So that's just an example. But so we go from the people, the money, the project, and then we just follow it from there. In other words, what the sample rates are is it's just a very green field where they have done nothing more than trenching. Trenching tells you almost nothing, but if it's good, the companies love to brag about it. But it means very little. It just literally are scratching the surface. That's what a trench is. You literally scratch the surface and get some indication of what the grades are, what the minerals are, and that type of thing. So that's it. We're probably going to do a series later on from my staff that will be like a video series that kind of explains it more in depth. There's a lot to it. And, of course, every case is unique, so we try to drill down as far as we can, excuse the pun, to determine whether or not it's worth even speculating on. So hopefully that was some value to the person who asked the question.
Very informative, David. Thank you. Our next question, I guess we've had several questions come in about energy and oil. I'll try to bring some of these together here. Could you talk a little bit about where you see the oil prices going, if you see a near-term recovery, and do you think there's going to be any type of impact on the U.S. economy if oil prices stay low?
Okay, very good. First, I'll preface it with I do study oil. It's not my primary study. There's people that are far superior to I on the oil situation. However, I'm no slouch. I mean, I'm fascinated with life in general, and especially investing and how these markets interplay. So nothing's more important really than oil, because energy is more important than any commodity. Having said that, I think we have not seen a bottom yet. I do believe strongly that we're already seeing the effects of the weak oil price in the fracking sector, and it will really manifest fully probably in about 5 months. As projects are put on hold, drilling has subsided, wells that are fracked are not completed, all those things are taking place now. I think that trend will continue. As far as seeing the price move higher and when, those are very difficult. It's like asking me, when's the price of gold and silver moving higher? And, of course, I kind of get paid to forecast those things. Oil, I'm reluctant to do it, but I might be better at it for metals markets, which I'm very good at, by the way. I mean, I've called every top so far in the metals markets. I have not got the bottoms right. But I don't see it being sustainable for a very, very long time, but I think longer than most of us think. So I'm looking out at least 6 months for these, 50-ish or dollar prices. And I have to give the caveat that I always give that says we could see a black swan. There could be something that takes place in the Middle East. Certainly it's heating up daily that will provoke a sudden increase in the price of oil. So factor that into your thinking, that with what's going on between Syria, Israel, the Ukraine, which I know is not the Middle East, but all this war effort, especially the Middle East. I mean, this Iran, Syria, Israel situation, Yemen, with Saudi Arabia, the King dying. I mean, all of these factors are just very, very difficult to analyze, but they're there. You have to look at them objectively, and you have to say, wow, that can impact the oil price, and it can do so suddenly.
Very good. Thank you, David. And I guess our next question, moving back to precious metals for a moment. We have about 3 minutes left here, but this investor is wondering, what's the best approach for an individual retail investor to take in precious metals? Should they be looking at the physical commodity, an ETF type of play, or mutual funds, a basket of individual equities? What's really the best strategy for an individual investor?
Well, I have stressed from the beginning that for any investor, retail or above, to start with the precious metals first. And the reason I say so, and I'm not a bullion dealer, is because it's the only asset class that's basically outside the system. Everything else, stock, bond, mutual fund, limited master partnership, private placement, whatever you name, has got some counterparty risk and some clearing, some method that it has to be cleared through, a broker, or something like that, or even a bank it has to clear through. Where if you own physical precious metals, it can be a direct way to purchase something. So it's money that's been money for thousands of years outside of the system, so to speak. So that's step one. As far as where you get the most leverage and the most advantage as an investor, there's no doubt in my mind that the mining equities are so undervalued right now, you can buy $1 for 30 cents in many cases if you know what equities to look at. But that's something we do, and I don't want to oversell my report. There's others that write in this field as well. But that's where the greatest leverage is. But even knowing that, I still think you're better off starting in the physical metal, and they're both undervalued, both gold and silver. So that is something that we need to get into people's thinking that they should start there, and it doesn't have to be an oversized position. When I wrote this chapter in the Investing Rules book, I said 10% is probably enough for most people, and that is true. So you could have like a 5% physical position and use the 5% spread out between top tier, mid tier, and speculative positions, and you're probably going to have a great time loving the metals up or down, because when they go, they really go.
Very good. Thank you, David. That actually takes us to our allotted time. We were just speaking with David Morgan of the Morgan Report and SilverInvestor.com.